about what's going to happen to the markets now. We've got Karthik Kumar, fund manager at Axis Mutual Fund, joining in on the show right now. Karthik, hi, good afternoon. Welcome to ET Now. We were just debating this morning as to how picture perfect the setup is looking like. Everything from low inflation to now lower EMIs, lower interest rates on all kinds of loans, lower taxes, good monsoon. Everything seems to be, playing out pretty nicely. Where do you think the trickle-down effect of all of this is going to, be visible? Karthik, if you could just unmute yourself.
Sorry, I was on mute. What I meant is the trickle-down effect we will see a few months down the line, because what we've seen is as we gone through the earnings seasons, our earnings is still being cut on the margins. For the reasons that you mentioned, I think down the chain around 4 to 6 months, we will start seeing earnings revisions, negative revisions kind of stop, and from there on earnings outlook should get better, and that is when I think the markets will start trending upwards as well, or more likely to start trending upwards then.
Karthik, there was, not just myth, but data actually backing that mutual funds were still not all in the market, and they still had high cash levels from April end onwards. What about now? How much cash levels are you sitting on in your schemes?
From our own perspective, we are sitting on very limited level of cash. We have not taken outright bearish view across in terms of just the cash levels. So we haven't taken a massive cash call there. So we do have cash to deploy, but it is not out of whack. But having said that, the backdrop is quite positive, be it both in terms of domestic inflow or even FI inflow. So domestic, as you said, the cash numbers are higher at the industry level, so that is a positive. And even on the FII front, FIs have turned positive. Also, the macros for FI, be it in terms of interest rates, in terms of expected policy path for interest rates, especially in the US, the dollar weakness, and the fact that FIs are still underweight our own markets to some extent, all of these things are positive from a flow perspective, be it whether you look at it on a DII or from an FI standpoint.
Right, Karthik, I want to understand that amid a market setup like this, where have you placed your overweight and underweight bets? What is your sector positioning looking like at the moment?
Okay, so from a style perspective, I think the markets have, especially given the policy uncertainty emanating from US with regards to imports and so on and so forth, markets have taken a skeptical view of growth as a style in general, and in fact they've taken shelter under value and some quality names quality as a style over the last few months, and I think that is likely to change going forward, because especially in an environment where our earnings continue to be cut on the margins, growth as a style, earnings revision as a style will continue to be, I think, will come back to the fore. So that's from a style perspective. From a sector perspective, I continue to remain overweight pharma because it's while the sector is underperformed, I think for the year so far, as we get more certainty with regards to the policy developments, especially in US, I think the earnings is there. So I think that sector could recover. The other is we like financials overall. There are different buckets within financials, be it financials, NBFs, private banks, NBFCs, or even some of the capital marketplace. I think it's a good mix of different styles that you want to get into. Those are largely our top sectors that we are bullish on. In terms of areas where we are kind of light on is largely consumers. Within consumers, the earnings has been tepid. And if you look at FMCG consumer staple names, so far the earnings revisions have also been slightly negative. So when things change around for the reasons we discussed, including good lower inflation numbers, earlier than expected monsoons, the tax effect kind of trickling down, we do expect earnings pathway to kind of improve down the chain, and that's when we'll be happy to look at consumers again.
Interesting. But Karthik, do you not believe that all the factors that we just talked about, that surely is going to propel consumption? I mean, if that doesn't, I don't know what else will.
Absolutely. I couldn't agree with you more there. Yeah.
Okay. So in anticipation, you wouldn't turn bullish, right?
So as of now, the data is still yet to come in. So as of now, we continue to be in a wait and watch mode, both in terms of the earnings and also in terms of valuations. But I think there are signs there, and if we'll keep an eye out for it, and as things start playing out on ground, is when we will kind of reevaluate there. But as of now, as things stands right now, we still continue to remain a bit light on consumer FMCG plays there.
Kunal, what's a better contra call right now? FMCG, staples that is, or IT?
IT. So on IT, we continue to remain kind of neutralish to slightly underweight, because with IT, what we are looking at is more name specific, and also the sector has underperformed over the years so far, and valuations are kind of reasonable. So when we get clarity with regards to the macro environment in developed markets, and especially in the US, and policy certainty, I think IT selective names in IT could benefit out of that. So we are kind of neutral to underweight depending on the fund that one is looking at. But consumers, yes, we are underweight as we stand as we evaluate markets right now.
What's your sense on the charts? IT or FMCG?
IT. I think there's a strong chance that IT should make a comeback for itself. Momentum is coming back into the individual IT stocks. It's not the case with many of these other FMCG names. So I think looking at the way the setup is for many individual stocks on the large cap, mid cap IT names, there seems to be a very strong indicator that we are looking at a potential much more stronger breakout. And by the breakout, I would probably mean that not just a 200, 500 pointer move on the IT index. We could be looking at a point where the IT index could rally by at least another 5 to 10% swing from current levels. So at 37,500 where we are, we could be looking at a point where the IT index may come back about the 40,000 mark as well.
Okay, so that's a take on IT versus FMCG. Kunal placing his bets on IT. But Karthik, coming back to you once again, how are you placed when it comes to autos and metals? Because both of them have significant overhangs coming in from the rare earth mineral issue and that magnet issue that's acting as a major headwind right now. So how are you positioning your portfolio when it comes to both of these sectors, autos and metals?
Okay. Metals, in terms of metals, it's not a view on sectors. We may have selective exposure to metal names per se, but it is on a stock level basis, bottom up basis, rather than a top down perspective. The same with autos to some extent, where we do have exposure to the leaders within the auto space, be it on the 4-wheeler side or on the 2-wheeler side, where there is still growth visibility. Despite a general slowdown in both these areas, we still continue to stick to our winners there. So it's a lot more selective within both these areas. As far as the policy as far as the issue that you mentioned, that's something that needs to be monitored on an ongoing basis. But right now, we are positioned with the leaders in both, be it in the 4-wheeler or the 2-wheeler space.
Okay, and I'm just going through the website right now, Karthik, and I can't help but notice ICICI Bank is a stock that you're rather bullish on. If you have to play the entire large private banking space in the pecking order of, let's say, HDFC, ICICI, Axis, Kotak, how would you be rating these 4 banks and what would your weightage be?
From a compliance perspective, I wouldn't be able to comment on single names.
Okay.
But I think given what RBI has done over the last week, I think the entire the lot of the overhang around banks kind of goes away. And in that context, when you look at valuations as well, private banks look quite decent there. And with this overhang away, I think the whole basket as a whole looks good. And as I said, financials, within the larger financial space, there are different kind of opportunities. If you look at NBFCs, or one looks at capital market plays as well, where there is growth, it is slightly higher valuation, but there is growth there. With banks, you get more solid, kind of predictable growth at reasonable valuations. So depending on what fits your bucket, you have different opportunities within financials as a sector right now.
Right, okay. Just looking at some of the other names right now in the market, and clearly it's the capital market theme which is once again propping up, and there too you are seeing that churn play out all through last week, or in fact, that's really been the story for the last 6 months. It's always been sort of BSE, CDSL, they've been the go-to names. And now look at IIFL, for instance. Of course, it's that, gold financing angle as well, which is at play. That's holding up a solid 7.25% right now. MCX looking strong. That strong stock is holding up almost 6.5% as we speak. And the smaller banks are, where the traction is. Bandhan Bank up 7.25%, RBL up 5.5%. So MFIs, smaller banks, like Karthik was saying, it's clearly financials, which is the go-to space. But Karthik, within the capital market theme, what is it that you think provides value still?
I think it's not a case of value there. To be fair, the valuations are slightly on the higher side across that space. But having said that, there is a lot of growth visibility, and given what has happened from a macro perspective, and as we also talked about, be it in terms of markets having a lot of possible tailwinds in terms of flows from domestics, FIIs. So I think a whole range of players, be it AMCs or be it companies that benefit from uptick in volumes or IPOs in the capital market space, all can benefit across that space. So I think while valuations can be a bit stretched there, but growth visibility is quite good. So one needs to be selective within that space, but it does present opportunities.
Karthik, just want to come back to the consumption theme, and if you put away core FMCG for a bit and talk about the other baskets like retail or your non-FMCG consumption, it's not, or for that instance QSR, it's not been all that bad when you take a look at consumption, barring the main FMCG counters. Would you still be underweight on the entire theme of consumption if you are barring FMCG, the likes of retail, QSR, or significant pockets or something that, or selective pockets, pardon me, something that you're liking?
So within consumers, aside from FMCG, of course, where we discussed our views, we are selectively overweight in terms of, let's say, travel and tourism. That's one area that we are kind of bullish on. In terms of modern commerce is something, modern retail is an area, depending on the company, of course, that's another area that we are selectively bullish on. But these are more bottom-up plays. Travel and tourism, you can probably count as one of the areas where we still continue to remain bullish or positioned well across that space.
Okay, and before we let you go, just want to get your view on this entire thermal, solar, renewable energy theme that we're seeing lately. All of these power stocks have once again started seeing some upward momentum. Are you placing that theme anywhere in your portfolio? What's the stance there?
So we are kind of neutral on that space. We do have exposure there selectively. Again, it comes to the kind of funds that we are talking about. But within the funds that I manage, which is mostly from a quantitative perspective, I have little exposure or limited exposure to that space.
Okay, Karthik, thanks so much for joining us. On that note, we'll let you go. Our last about 30 minutes left of trade right now.